So, Mr. Iyer, your thoughts then on then if this is indeed a bull market and prices aren't correcting as much as you perhaps like them to, how do you make money?
Actually, prices have corrected. I mean, if you look at what happened to the mid-cap about a little less than a year back, they've corrected a lot. And if you look at the overall market itself, it's gone down by 20%. It can happen in the middle of a bull market that leadership changes. And I think that's what is happening. So some of the stocks which really led the bull market in the last 2-3 years are very, very expensive. I mean, so, but I think there are other companies which have been ignored which are doing well. So I don't see the market overall might look overvalued in terms of the index itself, but I think there is enough pockets of value inside the market.
Since we're already on the valuation subject and argument, this whole classic debate between buy growth at any price or buy growth at a reasonable price, but then what is reasonable? I mean, how do you evaluate the sustainability of that growth? How do you negotiate some of these issues? Raamdeo, you want to take that?
Yeah, so valuation is a large subject, and particularly in this kind of time, as I said, it's not that exciting because all the stocks where there is a longevity of growth and stability of the return, those stocks are kind of more than fairly valued. So, I mean, as you said, growth at any price. Of course, in investing, if you buy at any price, you're not going to make money. Or you're going to make less than even fixed income money. Like if you make I mean, we have seen this wealth creation study is only about valuation. So there we have seen if you buy at 3 times growth, so if growth is about say 20%, you buy at more than 60p multiple, your returns are not going to be as much as even the market. You'll underperform the market, howsoever good a stock you buy. So if that is so, you can decide. So what is going to happen if you chase this highly valued companies in your portfolio because they look very good, your portfolio looks very decorated, you feel very comfortable. But I'm quite sure after 5 years, the return from the same stocks in the portfolio would be, say, if market has done 11%, you'll do about 8-9%. So that kind of risk is there. So if you want to really make 15-20%, you have to make that extra effort, find those stocks where something which market doesn't know.
Okay, I'm going to come to that, something that the market doesn't know in a bit, but just to take the valuation point forward, and here I found some very interesting insights in the book with respect to your own experiences. So, I mean, you thought that HDFC Bank at 4 times book perhaps is too much, but then it just kept going higher. Similarly, maybe at a certain point in time, Bharti was not giving you the kind of roast that you would have liked to see because you come from that classic school of thought, but then it went on to sort of, become a much bigger compounder from there. So then, in that context, how do you look at price?
So I think, P is the most ephemeral concept. Valuation is a function of many things. Valuation is a function of growth. It's a function of the quality of the business. It's the function of governance. And at a macro level, it's the function of liquidity in the system and many more things, right? Sentiment, etc. But I think one of the lessons is that obviously if one thing is very clear, as Raamdeo rightly mentioned, that you're not going to make money if you buy no matter how good a stock at an obnoxious valuation. There is no way you can make money, right? Having said that, I think you have to look at valuation in a particular context, and that context is that what is the size of the business today and what you're paying for it versus what can the size of this business be in absolute terms a couple of years down the line. The reason why classically a lot of people missed HDFC Bank was because optically you only looked at one number, which is a price to book or a P. But you forgot that the opportunity was so large and somebody who executed on that opportunity so phenomenally that what you paid when it was 1/10 the size didn't really matter. But having said that, there are two important things. When you take those kind of calls, your investment horizon has to be reasonably long. Nothing happens in the short run. So what is the stage or maturity level of that business and in what context you are buying is very, very important. So, it's very difficult for me to explain valuation in very simple terms because if it was that simple, just a P ratio, then I think any mathematical formula would have worked. But it's not that easy. So it's a context. You have to look at where you are in the markets and then decide whether you want to pay that value for those stream of earnings or not.
Okay. I'm going to come back sort of
I
once
just
again.
want to
Yeah.
sort of ask a question here because given the panel discussion topic, so I know everyone here is a regular reader of FT. So there was an article a few days back in FT that growth has outperformed value since the last crisis, but that was under a low interest rate regime. Now with the interest rates inching up globally, do you think there is a change in that? Sort of your broad thoughts.
Rajshekar, you want to start with that? We haven't heard from you.
No, when you say growth has outperformed value, in every investment over a period of time, there are two sources of return. One is the earnings growth in the company, and the other is the valuation expansion. I mean, like Hiren said, you can use any method of valuation, but the market doesn't trade at a particular valuation. Sometimes it trades at the higher end of that valuation, sometimes it trades at the lower end of that valuation. So, in very simple terms, if you can call it P expansion. So, if you bought a stock at 20 times earnings, and it's earning X, and it goes to 3X, and it goes at 40 times earnings. So you got two sources of return there. But I think the expansion in earnings cannot go on forever. Like they say, trees don't grow infinitely, you know. So once it's gone to that stage, I think, so when we say growth has outperformed, I think we've probably reached the limit of how expensive these stocks can get. So it is risky, as Raamdeo said earlier, to buy stocks at any price. But if companies are earning well and they are moderately valued, then they are okay.
So let me ask the panel, in the current market context, pockets which are well known, overvalued, whether you would still have comfort if you were buying fresh. I'm talking about the new people who are in. So for instance, consumer, I mean, something like Lever, some of its peers, and things which are trading at 60, 70 times, would you have comfort?
No, as I said, you might have comfort in the sense that you won't lose money there, but you might end up after 5 years not making any money in the stock or not a lot of money. So, you know, if you're going to sacrifice return for safety, you might as well buy bonds.
So Raamdeo sir, if one were to force you to buy something that is anyway expensive and you know it's not at your price, in the current market, what would that overvalued pocket be that you could still go ahead and, you know, put something on?
It's not that there is no opportunity. There is opportunity, but it's not staring at you. Like, see, typically, the fun in last 25, 30 years been that you could get enough stocks to double your money in 3 years. I mean, that used to be my formula. That look at the stock, when you hit the opportunity, you're looking at a doubler. Later on, either it turns out to be a dud or it turns out to be 10 times. But when you start, there was clearly a case where business was reasonable, management was reasonable, growing rapidly, and available at 15, 17 P multiple or 12 P multiple. That kind of opportunity is not there right now. But still, I mean, if you want to make, so obviously, instead of 25%, I am willing to take less than 20%, 18%, 17% kind of return. I mean, see, what is going to happen is that you keep buying what you like and what is right. Say, we call it QGLP. Quality stocks we keep buying, growth stock we keep buying. That I'm not going to compromise. In fact, I'm willing to compromise lower returns. Somewhere along the line, what will happen is that Indian economy, which is slow right now, will pick up steam. And it will surprise everybody. It's like, we don't know when it happens. Like in 2003, we thought that we are in wrong profession. And then what was knocking the door was the history's biggest bull market, 2003 to 2008.
Yeah.
So we don't know what is in out there. Will it be because of the liquidity? Will it be because of the earnings growth? And why it will come? We don't know. But it happens, it knocks the door and it comes. And at that time, you don't have a full portfolio. You will be just bypassed. You can't be timing the market.
Okay, fair enough. I want to move to the next thing, and that's the Q in your QGLP, quality, this whole concept, because we've been in an environment where we've seen a lot happen. We've seen companies, you know, go through the roof with leverage. We've seen IBC happen. We've seen promoter issues happen. We've seen auditor resignations happen. Now, how do you start defining the Q? What all goes in Q? What are your check marks?
Yeah, so Q is very clear, very commonsensical. I mean, we have bifurcated into two. Quality of business and quality of management. There are three types of businesses: great, good, gruesome. So you have a very good business, you have good business, and you have outright bad business. 90% of businesses are outright bad businesses. So if you can cut out that bad businesses, I mean the companies which either make losses or make the profits less than cost of capital, I mean 7%, 8%, and you know there's all these so-called textile companies, types, you know, or sugar companies. Even a lot of cement companies are also like that. So they don't make money and they have the fancy names and kind of thing. These, If they don't make money, you're not going to make money, very clearly. And there are 80-90% of the companies, they come in that category. Then you have the good companies which earn about 18-19%, like all the well-run banking companies, finance companies, they're in about 20. Then you have great companies like
Are they all
30-40
well-run?
companies. Pardon?
Are they all well run? The banking and
Not
finance
all,
companies?
not all. Some of them
Some
are
of
well,
them.
some of them. Then you have the wonderful companies like Asian Paints, Hindustan Lever, Nestle. I mean, there are 25-30 companies like that. They are great companies. If you can get great company at a reasonable price, you are done. I mean, you need 4-5 stocks like that, your portfolio will do very well. But I try to make my entire portfolio of 15-20 companies filled with good companies or 1 or 2 great companies. And I make sure that there is no dud company in my portfolio, no bad businesses.
Okay.
7-8% return on equity businesses, I just hate to have in my portfolios. And that's where people get stuck, because they look very cheap, but they're actually most expensive businesses.
Okay. Hiren, your thoughts on quality? Because, I mean, as I was just sort of reading some of the anecdotes, when you picked up CESC at that point in time, it was a leveraged company. There was a lot of debt in there. I mean, typically it perhaps wouldn't qualify to be in the quality framework. It's not the most unleveraged balance sheet out there, but you still went ahead and bought it. So,
Yeah, so that particular trade was, in fact, I have written there in the book, I think it is mentioned, that I read security analysis. We had just completed 1934 security, that thick book. And there in that one chapter, he talks about option value. And Dhruv was there, I had discussed with him in the morning that the best option value is in CSC. I did this thing screener, and the screener was interest cost and current market cap. And I did the ratio, interest cost paid, because interest was coming down from 12% to 7-8%. So I said, which are the companies which are paying more than the current market cap as their interest cost? So interest cost of CSC was 400 crores, and the market cap was 90 crores. The whole of Calcutta, monopoly, generation and distribution, and they have done a wonderful job. As good a electricity supply in last 10 years as Mumbai. Uninterrupted and high quality power. 90 crores you could get it, for 90 crores. And 13 rupees was the price, and you could get it like, it was not listed in Mumbai. You had to buy it from Calcutta. So we bought that, and and in fact management bought. They did the QIP only at 50 rupees. They themselves didn't believe in their own company.
okay.
We believed in that. So you get sometimes, I wrote about 2003 was one of the greatest time in last 30 years to buy stocks. The price to book up the market itself was 1.2 or 1.3. Reliance was about 7p multiple. I mean, and see, you get good stocks. I mean, you get cheap stocks where the market itself is cheap.
Yeah.
It's like a real estate market. If the price in Nariman Point in general is 1 lakh rupees square foot, you cannot get, even the Jaggi Jhopdi will be like 50,000 rupees square foot.
Absolutely.
So that's what happens in the stock market.
Absolutely.
If the market levels are high, 23, 24p multiple, even bad stocks will be 15, 16 level.
Absolutely, absolutely.
So we have to,
Yes.
so right now it's a expensive market.
Okay, take your point. Hiren, quality in today's context specifically, because there are a lot of issues happening. I mean, we're having, SEBI cases opened up, and there are whistleblower issues coming up. So just how to ensure that what you are holding, you've done all the possible quality checks beyond what the P&L is telling you, or beyond what the leverage levels are telling you.
See, I think in a tough market is when the boys and the men are separated. It's not something which is new. It happened in 2011, it happened in 2013, and now again it's happening in 2018. There are always, the market discovers these so-called low-quality businesses. I think the simplest method of defining quality at the first instance is, can a business earn a respectable return on capital, provided obviously you are confident that the numbers that you're looking at is something that you can rely on, obviously. So I'm taking that basic assumption and I'm not going beyond that. So for example, if a 10-year bond yield in India yields you 7.5%, which is the lowest risk investment you can make, the question we have to ask is, if a business cannot make 2x of a 10-year bond yield, do you really want to own that business for a long period of time? Now, temporarily it may be below that, but over your investment horizon, you should have a respectable return on capital. Quality also comes from discipline in capital allocation. And the third thing, which is the most important, is that does the business generate operating cash flows, right? And then over time, free cash flows. Because you may be doing all the good work, you may be doing all the good, great projects of the world, but if you can't convert your sales into operating cash flows, then there is no meaning, right? And then obviously there is things like management quality, which only you can, you have to go back in history and, look at how these managements have been disciplined about their capital allocation, and more importantly, how have they dealt with their minority shareholders. Very, very important, right? So if a business has issued capital several times, and if the shareholders have never made money, then you know that, it's not a great management. So quality has several aspects, some things which can be quantified, like return on capital, cash flow, and there are some things which you have to glean from the actions of the managements over time. And you have to look at companies, how they behave during good times and bad times. And that will tell you the quality of a business.
Also, Hiren, since you're talking about good quality managements and companies, and you have a very long history of investing, so can you name some companies where the promoters are like learning machines?
Oh, there are several. I mean, obviously the most obvious ones are, HDFC, Bajaj Group, right? I mean, you look at Bajaj, they've never done a capital misallocation, for many, many years. There are a few young entrepreneurs who have come and are displaying some of those characteristics as well. But you need a good amount of history to be able to say that, these are good quality companies. For example, there are some businesses which are very good, like, VIP is a very old company, right? But by and large, they've stuck to what they're doing. It's a clean balance sheet. They've not done too much of adventurism. You could classify that as a good quality management, because they've been by and large very disciplined about the way they run a business, and it's a good business, right? So there is this whole established business groups, and then there are a few young entrepreneurs. And actually on this whole question of P's and qualities, I believe what this market at this point in time lacks is we need more supply of high quality entrepreneurs. And because we don't find too many of them, is when money just keeps chasing those few high quality names that we've seen all along, right? I mean, Godrej is another example of a group which is reasonably high quality, and there are quite a few you can name.
Then what's the exit strategy on,
Well,
on an investment that's really working well?
There are some stocks which are of such good quality that you have to think a lot before you sell. It's not that you should never sell them, because two things can happen. One is that they could go up so much that you can lose a good portion of your profit. Second thing is you can hold them in the next 5 years if you've not made any money on that. So, you compound your money very well for 5 years, and then for next 5 years you don't make anything. So both can happen. So it's a tactical decision, and I would say if you think about it carefully, and if you take a call on it, you would get it right. I'll give you one example here. I think a company which is very popular in terms of governance and of course quality of business and all that, Hindustan Lever. I mentioned in the book also, between 1990 and 2000, Hindustan Lever stock went up the earnings itself went up at 28% per annum. Stock went up some between 80 to 100 times, So the conventional wisdom in 1999-2000 was that all these IT companies may stop growing, but Hindustan Lever is the anchor of your portfolio. You should always have it. Over the next 6 years, Hindustan Lever stock came down by 67%. Okay. So which it gave you no return for the next 10 years. So in 10 years, it goes up 100 times, and next 10 years, it gives you 0. So it come down to, so however good quality the company is, if it is very expensive, and if the story is changing, you have to be open to getting out of the stock.
They don't like good results, and in bad results, they find optimism. So, so you will not be able to make out what they're saying. You have to live with because they are concerned about being right in next quarter. Sure. But as an investor, we have to be right in next 3, 5, 10 years. So there is a huge difference in what they write for every quarter. And so we have to be very, very careful. We should not be too much carried away by very good quarterly result, and should also not be completely disappointed by very bad one quarter.
Bad quarter. Fair enough.
So, but I think India is on a growth path. I mean, even a bad growth is 7.5%. We have, one of the biggest change I see is that now inflation is sub 3%. It's crazy. This country should buy inflation, actually, and they can. Now with the change in the central bank, I hope if they cannot do anything, at least they must buy growth. And the buying growth could mean a little higher inflation. I mean, even the great guy has said 4% plus minus 2. I think they listen to only minus 2, not to plus 2. So, I mean, I hope they're able to, I mean, creating jobs is the paramount need.
It's time to spur growth.
Yeah, spur growth so that jobs can be created.
Okay,
I'm
pretty sure New Delhi agrees with you.
Yeah, New Delhi, but I don't know whether Mumbai guys agree with them or not. So,
We'll find out in the days to come.
Yeah.
So very quickly, last thoughts on what excites you the most, the idea for the moment.
No, as earlier also said, I think there is definitely a shift happening from larger number of companies doing well to fewer number of companies doing well. So there's a concentration of growth in fewer companies. So it's going to happen. India will build some really big companies which overcome all the problems we had in the past. I think the underinvestment in the sector is enormous. I'm talking about the stock market itself. So in 1992, we had as much as 17% of household savings going into stocks. It dropped to as little as 3-4% after the scam and all that. I don't know where it is now, but I wouldn't be surprised it was like 10-12%. I don't know. So I think there is still a lot more money which can come into the stock market, provided there are good enough companies to absorb that. And I'm not a big believer that it's government which drives growth. I think it is people's aspirations. And there is an entrepreneurial class in India which takes advantage of opportunities. So over the next 10, 15, 20 years, you'll find companies growing enough money to finance that growth from investors. So it'll keep changing.
All right, gentlemen, thank you very much for this very interesting conversation.